Hi everyone, I'm Damien.
And I'm Jeremy.
Welcome to our Suburb Data Podcast, episode 3 of our accounting series with Jeremy and Dom from DPR Accountants. So today, super funds and complex structures, and also the comparison with all the different structures we've spoken about on our 3-part series. Let's jump in.
All right. Thanks for inviting me back. I thought I might have had a shot at saying the intro, but no, you took it well.
Next episode, you're having a shot, okay? I'll make it happen.
Okay. All right. So this is the one that excites me. This is the one that includes super funds, and we've seen easy to say, an explosion of the super fund borrowing, because it's really unleashed a lot more people into the market than has been happened beforehand. So we hear a lot about SMSFs, and I've got a PowerPoint here as to the actual setup of them. Now, you do need to set up. You don't need to go to a financial planner to get the advice to set up an SMSF. You can just decide to do it, and an accountant can just set one up. But when you get to the borrowing side, a lot of the banks are insisting that you do see a financial planner to sign off on the advice that this is the right thing for you to do, to get a borrowing through your SMSF for a property. So you will have to see a planner and also normally a lawyer to sign off that you understand what you're getting into.
Would a lot of financial planners sign off on it or not?
No, a lot of them would, yeah.
Because the reason why I think they wouldn't is because if they're looking after an asset base of like shares or managed funds or whatever it might be, they're getting a clip of that ticket, aren't they? Where if it's the property's in a self-managed super fund, well, they're not getting a clip of the asset base of a share portfolio, are they? So they might be like, don't worry about property, just stick with shares and managed funds. I'm a legend. I know what I'm doing. I'll beat the averages.
Yeah, look, there could be some of that happening. I can't comment on that. I don't tend to think that happens. A lot of people just set up the SMSF and roll money from public super into their private super fund. So you'll then engage a financial planner that you may not know, that's just new, that's just signing off on the, hey, I gave them all the advice and they understand what they're doing.
I think it's important as investors, do your own research, but maybe you can talk to one financial planner, maybe a secondary financial planner, just to see different opinions, and maybe 2 different accountants. So I think if you're building out your wealth, it's an important thing to do. And I'm very big on diversifying. So I know a lot of people are investing in property in their own names, but they're also doing it in their self-managed super funds to take control of their journey. But you've got all this allocation to property in Australia, it does really well, but it's just something to consider about your liquidity positions.
Yeah. I do firmly believe that if you're jumping into any product, that you should understand at least what it looks like, because your financial planner may not be there or your accountant may not be there. You've got to be able to pull this thing apart if you need to, at least have some concept of it. If it's too complicated and you're not comfortable, then don't do it. So I like to run through with it and then make sure that at least people understand what they're getting into.
Perfect.
So with a self-managed super fund, so there's a couple of points to it, and we'll take this all the way down to the nth degree of borrowing. Now, at law, a super fund is a trust structure. So it's an extension of it's like a trust, but it's got a lot of special rules wrapped around it. So we're starting with our SMSF, and a super fund has members, and they're the people whose money is invested in the SMSF. So being a trust, next slide, we need a trustee. So this is what we're going to call super trustee. Now, we covered off individual trustees. Not a good idea for super funds, because if something happens to an individual trustee, then the super fund's at risk of being non-compliant. So it's easier to set up a company trustee at the beginning, and then you can have the directors of the trustee. The directors of that company are then the members of the fund.
Okay.
It's far easier to change directors of a company than to change trustees of a super fund.
So to keep it really simple, I've got a normal super fund and I want to buy a property, so I have to get a self-managed super fund set up. But I'm the owner of that property the super's the owner, but eventually when I hit to 60, I could have access to that property within my super at that time.
Yeah, you've jumped 3/4 of the podcast.
We'll get there. But long story short, like I'm taking control of the asset that's being purchased within the super fund. Like I'm saying, here, this is where I want to buy. I want to buy in Brisbane. I want to buy in Melbourne. I am able to direct where that money is getting invested within that entity.
Yeah, that's the big thing with SMSFs. They're no more or less tax advantage to any super fund, to any public fund. They don't have special rules in any way. There's one contributions rule that they've got a special set for. But from a tax perspective, they get taxed the same. They get the same tax exemptions. It's purely about control. If you don't want the control, don't do it. Or if you don't want to hand over control to a financial planner of all your money in an SMSF, don't do it. Just leave the money in public. But it's mainly the control factor, not the tax benefit. So if you want to invest in property, this is how you would control your money to go into property.
Okay.
So we have the super fund trustee, and then we need the super fund trust deed. Just like we had the trust before, they need a deed. Now we need a super fund trust deed. That just explains the relationship between the trustee and the super fund. So what's the role of the trustee, who's involved, and what's the super fund's role? Now this trust deed is a bit more complex in that it talks about contributions tax and who can be members and when you can start paying out pensions and things like that. So this deed's a little more complicated than a family trust deed because it doesn't have as much restrictions on it. Next. Now, normally what we see is that once we set up the SMSF, we then approach the public funds and initiate the roll-in. So roll in the $150,000, $200,000 from the public funds into the SMSF.
Mm-hmm.
So you will literally just wake up one day and on your little app with your super fund bank account, there'll be 150 grand. And it may be the most amount of money you've ever seen sitting in your bank account at a point in time. You then normally would approach your employer if you're employed and say, hey, I've got a new SMSF set up. I want my super contributions to start going to that bank account instead of to the public super fund.
And I'm surprised how many individuals don't even know what their super balances are or even approximates. They just think, like super at the end of the day is going to be your money. So you need to take control of it and not just go, I'll just put it to the side, doesn't matter.
Well, I'd say it's not going to be your money. Right now it is your money. You're controlling what happens to it. You just don't have access to it. Yeah, but it really is your money. And the super fund also then pays itself for investment and admin expenses. So a lot of people ask, if I set up an SMSF and it's going to cost $2,500, do I have to pay that? I'll say, well, initially yes, because you don't have an SMSF set up to actually pay the bill. But once it is set up, you can then reimburse yourself. So a super fund effectively pays for its own setup costs and owned administration. Take away the roll-in. So the contributions continue on, and now we have a target property. Now, unless you've got the money you need in cash ready to go in the super fund, you're now going to start embarking on the whole how do super funds borrow. And when they wrote the rules for this, they said, super funds can't borrow. That's the fundamental rule. And to try and make it to a point where we could get super funds to borrow, they said, well, rather than just changing the law to say that super funds could borrow, we'll write a whole bunch of new rules to add onto the back of it to make the legislation bigger. And they've kept the fundamental rule that super funds can't borrow, but you set up another entity that can borrow and holds the asset on behalf of the super fund. So then comes along, next slide. So now we need another company, and this is the borrowing trustee. And so the rule says, the super fund can't borrow, but you set up another company, it can borrow, and it owns the property on behalf of the SMSF. And to describe that relationship, we need, next one, there we have what they call the bear trust deed. And the bear trust is in you can't see it. It's effectively see-through. That super borrowing company, it exists. It's on actually the title of the property, but it doesn't do anything. Its pure purpose is just to be there while the property has a loan for the super fund. So going next slide, the property will pay rent. The rent goes to the super fund. And next, there's also the bank loan and the property expenses. They all come out of the super fund. So that bear trust says, the super borrowing trustee, I'm here, but I don't do anything with this property. I'm just here to own it on your behalf. You take all of the money, you take all the risk, and you pay all the expenses. Now, is there another slide after that?
I think that's it.
That's it? Yeah. So what does end up happening in the long run, once that loan gets paid out, you go back to the Office of State Revenue or Service New South Wales and you get the property transferred directly over to the super fund, and the borrowing trustee actually collapses and disappears. So long run, the property will be owned directly by the SMSF once there's no more loan. So that company only needs to stay there while there's a loan in place.
Why does that need to be there again, the super borrowing trustee? Why can't I just be direct? Because I guess anyone looking at this going, this is complex.
Yeah, it is, and that's why they cost a bit more. Because it's the bank loan. If there was no bank loan, you wouldn't need the borrowing trustee. Okay. So if you have the cash in your super fund, you just want to go buy a property, you can do that with just the SMSF setup. It's once the borrowing comes into play, and it says, because they wrote the rules that super funds can't borrow, and that is still the rule. It's the borrowing trustee that actually holds it on behalf of. So that's how they've gotten around that.
And is there the way that they assess the lending within these funds is, or the super borrowing trustee is the contributions coming through? So they might look at your pay slips and just making sure that's recurring and coming through.
Yep.
And the other one would be the rental income that's being assessed for the property is the other.
Yeah. So you tend to find that super funds qualify for larger loans a lot easier than individual names, because on your individual name, they're looking at, okay, well, you're earning this money, you're paying your tax, you're living your life. How much money have you got left over to buy a property to service a loan? With these, there's effectively now, with the super rate being 12%, 12% of your income is feeding away into super already. So there's 12% of your salary, which you can't see. You're not in control of that at the moment, just disappearing off into Gaga land. You can now grab control of that and use it to say, well, that's now part of the serviceability from the super fund's perspective. I've got this money coming in from that guy's salary, and I'm going to go buy a property with rent coming in. So that can then qualify for normally a larger loan. If you've then got the capacity to also put in additional contributions, that's when that really supercharges a super fund to say, now I've got three sources of income. I've got the direct super from the employer contributions, the rent from the property, and the additional personal contributions from the members that are there. It gives super funds a larger serviceability limit.
I guess you can be capped too, though, can't you? Like, let's say you're earning $200,000 a year. Well, borrowing capacity in your own name is going to be a lot easier because your serviceability is going to be through the roof. Where within the super fund, you're going to get capped. Like, let's say let's say 25 to 30,000. They're only taking for serviceability. So lending is going to be stricter within the super environment.
Yeah, there is a lot more controls. You can't blanket and say one's going to be harder than the other, because everyone's going to run out of limit at some point.
Correct.
So setting up an entity, like if you've already maxed out your personal limit,
then there's another way to get into property.
It's another way to get into property. Or if you've already just done one in your own name, you tend to look over and say, well, I don't have another $150,000 deposit and I don't have any more income to throw at the loan, but hey, there's my super fund with a deposit that hasn't been untapped. And with, as I said, rent and contributions coming in that I currently can't see anyway. So I can use that to buy another property and you do another one in your super fund.
With do you notice sort of any minimum balances? Because you hear people say, like, well, how much should I have within my super? I've always heard the blanket rule, 2 to 250,000, potentially set up as a self-managed super fund. So it might be like a couple. They might go, okay, well, let's set this fund up. You've got two contributions going through. Yep. They consolidate all their super, and that allows them to buy within a super fund. But someone who's only got 100,000, it's going to be a lot harder to try and buy within these funds. And I know a lot of the lenders also like to see some liquidity. So even after you purchase the property, they still want to make sure that you've got some sort of buffer there within the super funds.
Yeah.
But again, talk to your broker.
Yeah, broker, accountant, financial planner. Everyone's circumstances are different. You may be in a position where you've actually got some personal cash, so you might not have very much super, but you might have $200,000 of an inheritance outside. So, well, yeah, if you then throw that into a super fund, all of a sudden it makes sense. Certainly a balance of 50,000 is sort of hard to play with. 100,000, you're getting low. But with this, the borrowing ability, if your target is to buy a $400,000 property, well, then having 150 in there is actually quite a good start already. So you could start off with a $400,000 property, 150 grand. All the textbooks will say you haven't really got enough for super, but the target is 400,000
price point,
and that's the only way you can make it happen.
So quick summary is, I guess, if you're like, it's just another way if you want to keep accumulating. Super's another avenue. If you're maxed out in your own name, you can think about super.
Yeah, absolutely.
Well, what I like about it is the control, because I used to get a statement, I think, every 6 months from my super provider, a public fund, and they would say, dear Mr. Shepherd, here's how much of your money we've lost. Here's how much we've charged you for the privilege. And so I like the idea of I'd prefer to be in control. Can I pick where that money goes? So, yeah, that's the big plus for me.
All right, so now I've put together a couple of examples. Now this is going to be – I won't go bogged down too much, but the tax of the super fund is the attraction towards it. That's what makes them so they're expensive because of that diagram we just looked at. There's a lot of things going on there. Not very many active parts, but a lot of inactive parts.
What's the typical starting fee? So, like, let's say, look, I want to set up a self-managed super fund. What's like the initial outlay to set up a fund, self-managed super fund?
You're looking at 2 to 2.5 kind of thing, depending on if you know exactly what you want and you're just a walk-in dream client. You might be closer to that sort of what we would charge, closer to that 2 mark. 2.5 involves a little bit of advice, sitting down, talking over, do you want to go through this avenue, what does it look like, and making sure that, if a newbie off the street would be a little bit more.
So you could go, okay, money out of, let's say, my offset to fund the 2,500, and then I can get reimbursed from the super fund after the fund has been set up, potentially.
Yep.
Okay, perfect. So the fund is essentially paying up for the setup of the self-managed super fund.
Yeah, correct.
Fantastic.
Now, and then with the proviso, the borrowing, adding on those borrowing entities, I do them when you're closer, when you're ready to buy. So after the roll-in, after your contributions, when you're ready to buy and you need the borrowing entity, then you're looking at around about another $1,500 at that point in time, because there's another company set up and the bare trust deed.
How long does it normally take to set up? Average?
Average, setup can be about a week.
Okay, so pretty quick.
It's a couple of days to a week. It's for the paperwork to arrive. I still like to do wet signatures on those sorts of things, just because, have we fully moved digital? Some places still insist on them. So we still do wet signatures on our company startups and trust deeds and things like that.
Okay.
Yeah. Okay, so on this example, we're doing all this in super.
Mm-hmm.
I said they're taxed exactly the same as a public fund. So everyone's heard of that super funds pay tax at 15%, and during their accumulation stage, that's true. And they also get a CGT discount. It's not as good as individuals, so they get a 1/3 discount, so a 33% discount. So their tax rate effectively goes from 15 down to 10% on capital gains. Now, on all these different scenarios, I've got 3 different versions. One of them is going to be just your classic accumulation super fund. So the property grows and it's going to pay tax at 15, and we're going to sell it at year 10, and we're going to pay tax at the super fund tax rates.
Mm-hmm.
And then going further down, I'm then going to look at what happens if we retire at some point, because retirement can trigger the pension tax-free portion, and that's where super funds, being the most expensive, but that's where they come into their own, because their tax rate effectively drops to 0%. So that's that tax-free sort of world. And then the last version I've got is a bit of a hybrid, where we're going to run the super fund at accumulation, so the 15%, but we're going to top it up with personal contributions. And so that, to me, that's the one I like the most, because it actually means that I get a nice flat tax deduction. I don't have to worry about the property turning positive geared over time or anything like that. I keep making my contributions to my super fund and keep claiming as a tax deduction. So I've just got the 3 different scenarios to run through. So running through, again, 2-year columns, so everything's over 2 years, $500,000 purchase, growing at 5% per year, borrowing 80%, rent's 4.5%, interest at 6%. Yeah. Now the net rent. Now the super fund is going to be negative geared, just on the property alone, for those first 6 years in that case. Important to note that if a super fund has a negative geared property, but it's also then on the other side receiving contributions from 1 or 2 members making contributions into it from either their employer contributions or personal contributions, the property negative gearing does offset the contributions. So if I've got an $11,000 negative gearing, and then your employer might be putting in $15,000 of contributions towards your fund is only going to pay tax on $4,000. So you do get the benefit of negative gearing against other contributions.
And investment returns, like yield or interest that you receive within the super funds.
If there's other investments adding income into the fund, then that 11 would come off, whatever's there basically.
Because normally you'd seen a lot of super funds they're in managed funds. You set it up when you were young or whenever, they just put you in a fund and they're just ticking away. And a lot of people don't realise they've got insurances in there. They're allocated to global investments, Australian investments. So that's why I always think do a health check. Even if it's every year, have a look.
See where it's invested.
Great example.
Yeah. Now, the columns that we're looking at, these are actual returns. This is what we would call like a realised. So $11,000 loss is a realised loss. We've actually got to fund that from somewhere. And if your fund is not getting in extra contributions, you've got to put the money in, because it'll just literally run out of money. So we're kind of basing it on someone having a job. Now, if you had a salary of around $100,000, the employer contributions on that alone would be enough to keep this ticking over. So you've got your salary, you've got a property in super, it's not paying anything off yet, but you're not having to fund personally any extra money, because just your employer contributions will feed the super fund. Now we're selling it for the 805 in year 10. The cash released is the 405, because it's 805 less the $400,000 loan, interest only loan.
Okay, so we sell it for 805 and we got the cash release. So that's the minus the loan repayments.
Yep. Now, the unrealism here is that you can't have an interest-only loan for 10 years, but we're just, let's just run with it for the sake of keeping the stories the same.
And we haven't factored in like expense costs for like real estate agents and all that type of stuff, but we're keeping it simple.
Keeping it simple. And look, really, it's if as long as you keep the variables the same across all three, then you're just comparing what's best. The capital gain is 305, which is simply 805 minus the 500 buy price.
Mm-hmm.
And now super funds have said they pay tax at 15%, but they get a 1/3 discount. So the 305 becomes 203 after the discount. So a super fund will pay tax at 15% of 30 grand. So you buy it for 500, you sell it for 805. Super fund's going to get handed a tax bill of $30,000. Now the after-tax cash is simply the remaining money after paying the loan and the tax.
Mm-hmm.
And now the overall cash is the sum of that $15,000 on the far right there. So how much the fund has had to take from somewhere else, funding itself. Now, keep in mind the property had just gone positive towards the end of that, minus the tax, minus the tax and the cash that's left over. So the overall cash at the end of all that is $359. That's what you're left with at the end. If you embarked on a 10-year project, bought the property, sold the property, paid all your taxes, what's left in your super fund? $359 more than what you started with. Now I'm going to go down to version B, which is do exactly the same thing.
Mm-hmm.
So we can just race through those top few columns. But what I'm going to say is that we're going to pick and choose. We're going to be smart about this, and we're going to sell it in year 10 just after we've triggered a retirement. And what that'll do, that'll then move the gain is still 33%, but our tax rate drops from 15 down to 0. And so now our capital gains tax bill just disappears. Now, you don't have to be in pension phase when you start this project. All you have to do is be in pension phase when you're selling. So you just have to be smart with your timing. So don't go and sell it on the 29th of June the year before you retire. Sell it on the 2nd of July in the year that you also trigger the retirement.
Right.
And that's, again, I guess, talking to an accountant and a financial planner, maybe it's that preservation age. So like if I retire at 50, it's not going to – I have to tick off certain requirements. The big one is preservation age, which is around 60 for us.
Yeah,
so we have to get to 60. 60 and like let's say I turn 60 and I go, I retire now. I sell the property a day after, then I wouldn't be liable for any capital gain within the super fund because I've flipped it to a pension phase.
Yeah, it's a little trickier than that. It depends on what date you trigger the retirement, and then it averages out if you do it for the whole year or half a year. So there's a few rules around it. I think what you said there was paramount. Speak to a financial planner. They're the ones that are all over this, getting the timing right.
But I still think it's important for you to understand, like I wouldn't trust a financial planner blindly. I would still do a lot of my own due diligence behind the scenes and ask questions.
Yeah, ask questions, and they should be explaining it to you in a way that you understand it. Now, keep in mind here, we're talking about a person that's already made the point of setting up an SMSF, buying a property. So we're not talking about a person that doesn't know what they're doing. I would say this person's actually quite well educated. They understand structures. They've been a director and things for 10 years. They've been funding that. So we're talking about someone that's savvy in that financial space.
I think it's important. We'll have to get a financial planner on one day, Jeremy, I think.
Sure.
But I think there's that accumulation and pension phase. So sort of two different aspects once you start getting into that 60. But that's a good point. So 0% tax, which is the key thing that you're mentioning when they hit pension phase.
Yep. And that's just selling it at the right time and making sure you fund your circumstances at the right point. Now you can't retire at 50, as you said. You have to the lowest you can do is at age 60 is the earliest you can trigger this sort of scenario.
This is a great question because a lot of people will go online and think, okay, I can buy all these properties 3, 4, 5, 6. But what a lot of people don't understand is let's say you want to retire by 50. You potentially have to sell down a lot of your assets to wipe out a lot of your debt. Like your cash flow isn't enough. As you can see with a lot of the examples, when you're accumulating and taking on more debt, it's going to take a long time for your portfolio to go positive. So it's like a bit of a balance, isn't it? Like around your lifestyle and when you want to retire or reduce your workload and the back end strategy where you can talk to a planner and an accountant to understand that.
Yeah, and the plan can always be, well, I'll get it to the point where I sell one of the properties to pay out all the debt, and I'll be left with the 3, 4, 5 that are left over. That's a perfectly viable strategy. So of course, this one here, so the overall cash, the 390 is a lot higher, is a lot higher than the previous example because simply the super fund paid no capital gains tax.
It's a great one. It's really interesting.
And now the hybrid version, now I'm going to go back to taxable world. So we're not getting the best tax outcome on the sale. But what I've done here, I've introduced the fund and I've said, right, what I'm going to do, I'm going to personally contribute $20,000 this is a 2-year span, so $10,000 per year. So I'm going to make a personal contribution of $10,000 per year to my fund. And what that does is that puts more money into the super fund. So the annual cash, so it has a lot, so the negative gearing, it loses very quickly because it's now receiving an extra 10 grand a year. So it loses a lot of the negative gearing, but what it's done, it's shifted the negative gearing effectively into my own personal name because I can claim a tax deduction for my personal super contributions. So
up to a set limit though, isn't it, every year?
Up to a set limit. So there's a $30,000 annual limit that can apply. So we're talking about a fund that if you're on 100 grand, it's $12,000 of super contributions. So you could do another 10,000. You're at 22 for the year. You've still got space to make more if you want to.
And that reduces your taxable income. So if I'm earning 100,000 in the year, make that contribution in my personal name, it'll drop it down to 90,000.
Yep.
But you're only paying tax at 15% within your super fund.
Correct. Yeah. So you're saving tax at your marginal rate, and the super fund's paying at 15% on what it's received.
And this is on top of your employer's contributions.
Yes.
That's pretty good, isn't it? That's very tax efficient.
It's, well, the numbers will speak for themselves, surely. So you make the extra contribution. So yes, the fund's income has gone up and the fund's tax bill is going to go up. So the annual tax sits, the super contribution, the annual cash, the negative 1450 is only for the first year and it's positive geared every year after that. So I've just cost the super fund tax because it's got more money. The win is the personal deduction that I'll be claiming throughout this. We then have the same selling situation. So the 805 is the same. The cash release is the same. The gain is the same as the first example. So we've got a tax bill of 30 grand. I've got more cash in the super fund because it's received, what's that, $100 and something thousand. It's received my contributions of $10,000 a year or $10,000 a year for 10 years is $100,000. But what I've got to take into account is that little green box in the middle there, that army green box. I'm making a contribution of $10,000 a year. My tax rate, personal tax rate is 39%.
It's 20,000 a year, is that right?
$20,000 for 2 years.
20,000.
Oh, sorry, 20,000 a year. No, you're right.
Yeah, 20,000 a year. That's okay.
Sorry. So we're right up at that limit of that 30 grand per year. At 39%, I'm going to get a tax benefit of that in my own name. And that's what makes a massive difference. And it's $146,000 of tax benefit across the 10 years.
Okay, 146.
So I've had to put in 20,000 per year, but I've saved. But every year I save, or every 2 years I save 24,000.
And now we're moving down to after tax.
That's the three versions of the super fund. So we've got super fund full taxable, super fund going into pension tax free, and then a super fund receiving personal contributions.
Okay.
Then over on the summary tab, if you've been following the 3 episodes, I've done a comparison here of all the different versions. So in the same case, we're using the same metrics. We're buying something for 500 grand. We're borrowing 80%. It's growing at 5% per year. And then we pay tax at either, so personal, you're paying tax at your marginal rate. Company, you're paying tax at company rates. The trust, we used an 18% rate just
to keep it simple.
And then we've got super A, B, and C. The biggest one is super C, and it's because the super fund will make 374, but you also get a benefit personally of 146. So overall, the two of you together are $417,000 better off than when you started this project. And then you've got how each one compares in against that same set of assumptions.
Now with that 146, let's just have a look at that again, just so I'm clear. So let's say you're making super contributions of 20,000 a year. Is that right?
Yep.
For 10 years.
Yep.
So that's 200,000.
Yes.
And then Where's that 146 come from?
So the 146, at the 39% tax rate.
Mm-hmm.
So it's a little bit tricky because we're looking at 2-year intervals.
Okay.
So if I make 40,000 of contributions,
Mm-hmm.
If I make 40,000 of contributions, I get a tax write-off at 39%.
For those 2 year periods.
So it only costs me 24,000.
Okay.
So if we halve it to look at an annual basis, I make a $20,000 contribution.
Mm-hmm.
It only costs me 12.
That's right. So you go 20,000.
Yep.
We go 20,000 and we multiply that by 0.61.
Yep.
Which is like 100% minus a 39% tax rate that I'm on. 12.2.
Which is half the 24.4.
Yeah, got it. Okay. And that's where you get that number, that 146.
So I'm putting 20,000 into my super fund, but then the tax man will give me a $7,800 tax credit, tax benefit at the end.
Yes,
when I lodge
yes,
my tax return.
yes.
So it's only costing me 12.
Got it. So that's where that benefit is.
So now we've got now you can see what releases the most, and then the comparison whether they're better or worse. And in this case, all the other circumstances are not as good as super.
So super's number one. Super C, that example of where you're making personal contributions is number one. The lowest at the moment was the trust. So besides super, based on this scenario, then it goes personal, company, and then trust last.
Yes. Now, there's assumptions behind it. The trust is last because it's got a lot of costs with the land tax that comes into it. Plus also, now, if you can distribute the gain to people on 0% tax, fine. You'll get a better result. You won't avoid the land tax. Again, but if you've got people around you at higher than 18%, it could be worse than that. So that's why trusts we normally see not as the first vehicle. They are normally once other things are capped out, then we think about the trust. Or it's purely asset protection. We don't care about the cost. We just need it not in our name.
Now, what's the disadvantage with super?
The disadvantage with super is purely access. So I'm 20 years old. I do this for 10 years. I'm now 30 years old with all this money in my super fund and I can't live off it yet. I've got another 30 years to go at that stage.
Yeah, we had a question on YouTube comments. I think it was YouTube. There was a 29-year-old investor and he wanted to set up a SMSF. And I think it was his broker who said, "Oh, what are you doing that for? That's for old people." And I thought that could be good advice if over the next 20 years he's made enough from property investing to retire early. But if he started off with the SMSF, he's got to wait a lot longer before he can access.
It's purely access. If you just run the pure mathematical numbers and say, well, I'm going to do this. I want to buy properties, sell, make a profit, then buy another one or buy 2 or 3 and keep making profits, keep paying taxes and reinvesting and expanding. That's fine. When are you actually going to live off this money? If you're going to do it in your own name, but you're not going to have enough to retire until your 50s, 60s, well, then doing exactly the same thing in super, you haven't got long before that access rule is reopened, but you'll have a lot more money.
Interestingly, one thing we haven't, so actually to answer that, I think access is a really important point. So access is one. The other one for me would be, can I get a higher return in my own personal name where I've got control and I can retire that earlier? So if I can use that extra money that I'm injecting within my super fund, instead of me injecting extra money in my super fund, I can go investing in my own name and maybe turn over and get access to that money a lot quicker, because there is that risk that the government changes legislation in 20 years' time and go, we'll give you a bit of extra tax when you're in pension phase.
Yeah, look, and the $3 million limit is something that they've been talking about a lot. It's now been in place since 1 July. So do you want to accumulate more than $3 million? Run the numbers, see if it's still worthwhile.
Another, back to this, one thing that we haven't maybe looked at is buying an owner-occupier in your own name. So when we're looking at personal, we're looking at if it's an investment property. But let's say you use all of your money and you max out on your owner-occupier in an area that's going to have a lot of growth or prime for a lot of growth. You move in there 3, 4, 5 years, you get that growth, you sell, you avoid all capital gain, correct?
Yes, correct. Yeah, that's the ultimate tax-free vehicle is super funds in pension phase and your own principal residence.
You just have to be able to move a lot.
Yeah.
Move a lot and maybe renovate.
Yeah. Work from home.
This is gold. This is gold.
Yeah. But if you're investing in something, if you can't afford to buy your own occupier, you need to buy an investment property because you need that rental return for the serviceability. And the goal is, all right, I'll buy an investment property, then I'll sell it at a profit and use the money to buy a house for me to live in. Super's not for you. Not going to work. This has to be purely I'm investing, growing, and rolling over and keep growing.
Yeah. So would not suit a rent vestor.
If the aim was to live in it, no.
Yeah.
And it can be, and you can't live in it, and neither can your related people. Holiday homes are off the cards as well, Damo. Sorry.
So living in it. Okay, so that's one thing, you can't live in it in the property.
No, you nor anyone related to you.
Okay.
And what about projects related to like capital injection on that property? So things like a reno, subdivision, development, knockdown, rebuild, that sort of thing.
Yeah, it does get tricky, especially with the borrowing. If the property is owned, once it's either had a borrowing and it's now paid outright, or if you just bought in cash to start with, you haven't got much limits. But if there's a borrowing in place, you've got to be careful. You can do minor repairs and maintenance and some things, but you can't go and do major renovation work while it's got a loan there.
Yeah.
Before we move on, just off the cuff here, do you see a lot of people invest in like cars within their super funds? Is that a normal thing that people do?
We used to see a lot more of it, actually. Funny, a lot of the old classic sort of cars, they all went up around COVID. Everyone was, had money to put into strange things.
So that's a self-managed super fund. So they set up a self-managed super fund, go, I'm going to buy this car, and I'm guessing it has to be locked away and you can't drive it.
It can't be a daily driver. A lot of them have to have the like club rego, only driven once a month or something like that.
Oh, but can you drive it? Like, let's say I set up a self-managed super fund, buy this car within the fund. Can you drive it once a month or not? Is that
you should be trying to preserve the value of that
because
asset.
It's an asset growing. So the ATO will assess that going, is it a classic or not? It can't be like a, I don't know, old Toyota Camry. Yeah, Holden Captiva or something like that. Get it? No, that could be a classic, Jeremy. It's a Holden, mate.
The underlying point of super funds is they're investing money for growth. The trustee is put in place. They are looking after the assets of the fund to benefit the beneficiaries.
Well, I guess the idea is with a super fund is it takes a lot of pressure years down the track off taxpayers. Is that the whole idea with super?
That's how Paul Keating designed it. It was meant to be, hey, we're paying out too much in government pensions. Let's set up this forced saving for everybody with the aim to be that eventually government pensions will go down to zero.
And what if you hit, again, maybe more for a financial planner, but you hit 60, you take all that money out and blow it. That 1 year, let's say you got $2 million in your super, question, $2 million, you blow it all and you're waiting for that age pension at 67. So like you go overseas, you buy cars, you enjoy it all, and then you get to 67 and then you get the age pension because you've blown all your money. Do you see a lot of...
And you're living like someone on the age pension.
Yeah, okay. Yeah, that's it.
Yeah.
That's it. Yeah, that's what, yeah, I guess it's more financial if that happens a lot because you've got that gap, don't you? Like you could access your super at 60, turn it to a pension phase, quit work, blow all that money, take it as a lump sum if you like, burn all that money within the year, but then you've got a 6-year period to get the age pension, so you might have to go back to work again. So I think it's just really important to see this as try and forget about it, get it invested, and eventually you'll have access to it.
Yeah, and normally what they've done with super, they flipped it around like a while ago now. They've made it quite hard to get money in, but very easy to get money out. So you can take a $2 million super fund, sell everything, pay no tax, take all it out personally and go crazy. But try and get that $2 million back in, you can't do it. So the challenge with super funds is trying to get it to $2 million is going to be a challenge when you're limited to $30,000 a year in contributions. I mean, there's other limits, other contributions you can make, but the basic is 30. So trying to even get it to $2 million just through contributions is going to be very difficult. You're relying on the growth of the assets in there.
I'd love to ask a financial planner that question because I wonder if the ATO backtrack and go, well, you had $2 million in your super at 60, you blew it all. I don't know if there's any risk that where you could lose a bit of your age pension. So maybe if we do any financial planners, leave a comment for us.
Yeah.
It'd be good to understand that.
Yeah, it'd be around the gifting rules of the assets to get under the asset limits, yeah.
All right, moving forward. So that's a good example. I really like that. So a clear summary for me is super can be very, very effective.
Yeah, super coupled up with personal contributions. And what I like as I said, access is the big disadvantage. Access and cost. Now, when you're talking about a super fund that might cost a couple of grand a year to run, but if it's making an extra, at best, $100,000 compared to any other way, well, then I would argue money well invested.
Yeah.
Well, if you look at, I guess over that 10-year period, like if you got a 10-year time frame, like you're 50 and you're thinking, okay, I'd like to buy a property, maybe instead of going in your own name, you do shift it over to your super fund.
Yeah.
But it could be a bit of a balance though. Like let's say you are 50 and you've got a 10-year time horizon, you might quit at 60, work, and then maybe draw down a part pension. This is, again, talking to a financial planner, getting a bit tricky, but you can reduce the tax liability in your personal name because you're not earning that massive salary. You've cut back to maybe 1 or 2 days. So you've got like the combo. That's one thing I think a lot of people don't realize is they use a lot of their super fund to fund their personal property portfolio in their own name because they still might hold a lot of debt going into retirement. But if your asset base is 5-6 million and you've got $1 million worth of debt, well, you're still okay. You're 4 million in front. You sell a property.
Yep.
But a lot of people get scared of that debt. But as long as you can control the debt, that's the key.
That's right. And that's one of the questions that you see a lot of is, I've got $300,000 worth of debt. Should I take my money out of super to pay and just pay that off? So that's quite a common one. It says, do you carry debt into it? Making contributions is very tax effective while you're earning income. While you're earning income, it's very tax effective from a personal perspective. And my argument is, well, if you pay down debt, you're saving 6% a year. But if I just shuffle money from this bank account to my super fund bank account, I've made, well, if I'm getting a tax benefit 39 and it's paying 15, what's that?
Difference
the difference of whatever.
24.
24% better off. So that's like just by putting money from one account to the other account, it's like I've just earned 24%, which is not what I'm going to get by putting money into my offset account.
Yeah.
And I guess you're putting it in your, like let's say you pay off your debt that you might have, like your property portfolio, or you're paying that off and then that'll increase your personal income in your own name potentially down the track. So if you've got rental income of, let's say, 100,000 in retirement, but you've got all this debt and you may be neutrally geared or slightly in front, and then you take all your super money out to pay off all your debt in your own name, you're going to have some tax to pay in your personal name. But in your super fund, that could be, when you're in pension phase, all tax-free.
That's
so
right.
They're the things that people don't think about.
Yeah, that's right.
So when you hear these things, 5 properties, retire, this and that, like super plays a massive part in your debt repayment strategy. People don't talk about it because you put a book out there, retire on a certain amount of money every week, and they don't tell you about how it gets there. It's your super that's the engine behind you.
That's right. Yeah, and it's all about saving tax. So what I said on the first episode is that paying tax or not paying tax doesn't make you rich. Your advice is what makes people rich. It's my advice is what gets people to keep more of what they've made. So $100,000 of personal investment income, if you retire on $100,000 of passive income, you're still going to pay tax, and at some point you'll pay CGT. But you put that exact same portfolio into a super fund, you will stop paying tax from a decent age, from 60. You can have it that you stop paying tax and take that money tax free, and then the ultimate CGT will also be tax free. It's 2 very different answers.
Very good. Moving on to complex company.
Okay, so that's the basic structures. I thought I've just put together a couple of simple ones. So we've gone through all the different structures that we can have. And I've just things that you can imagine. So like anything, like art. So accountancy can be like art. We actually put together things that can suit circumstances.
Is it a science behind? I hear everyone talk about this science in their art that they do. There's a science in property investing, Jeremy, or what? You hear that, don't you?
It's all about science. The only art involved in investing is if you are investing in art.
Dom?
There you go. So this is wrapping art around science. So there's a science behind this, but you can go in with an artist view. And so this is the sort of stuff that I would do. People would talk to me about the scenario that they got. Those who've got certain family circumstances, or this is, they've got siblings and this is how it works. This is what the arrangements are. I just wanted to bring up two examples, 2 out of unlimited ways that you could structure things. So what I've got here is we've got a company structure. Now, we did go through companies beforehand, and I'm going to make one simple change to it. So if we just go through again, we've got the company. So the next slide, we need our directors. And the next slide, we've got now, instead of having individual shareholders, I'm going to put a family trust in as a shareholder. So we're combining 2 entities now. So then when you go to the next, And out of that family trust, I now have my beneficiaries that I can distribute to, and beneficiary 2 is in there twice.
Yeah.
But what that means is that instead of having fixed shareholders, instead of determining who are the shareholders of the company who then have to take the dividends, I put a family trust in as the shareholder, which then means any tax that the company has paid that I pay out as dividends later, each year I get to decide where this dividend goes. And it opens up the whole argument about franking credits and imputation credits and the refund from franking credits. This gives you a lot more flexibility than having fixed shareholders. So for the sake of setting up a family trust, this can save thousands of dollars per year if it gives you the ability to distribute to low-income beneficiaries rather than fixing it to people that have grown up from when you first set this thing up and they're now earning $90,000 and paying tax at higher rates. So that's just one that not come up with that we see quite often is having a family trust as the shareholder of a company. And the other one, then we're going through the example. So we're buying the property, the rent comes in, the property expenses come out. All that's the same. It's just who is taking the profit out of this company. Is it fixed or is it going to a family trust that's then variable and decided as you go?
Mm.
So that's one complex structure. And the last one, this one's an interesting one. This one, we used to set this up a lot in businesses. So we'd fund a lot of businesses, and where it stemmed from was because a lot of business loans, they would max out 15 years. So we talk 25, 30-year loans for property, but if you're borrowing to buy a business, a lot of banks will do a 15-year repayment cycle. And that shortens the repayments, shortens the life a lot, but it just means that your repayments get out of control really quickly. You have to have a high cash flow. Just think if you're paying something off in 15 years, it may be negative to start with, but it's going to very quickly turn neutral and then start paying and then turn positive because years 10 to 15, you're positive geared, you're paying tax and you're having to keep up your principal repayments. So this is where this originated from, and now we can see how it could apply to companies borrowing into properties as well. So we've now got an individual here, and they want to go buy a property. So we've got the property and we've got the bank on the other side. And instead of just going directly, so the individual with the bank, next, I'm going to introduce a company, just a straight up company, and I'm going to Borrowing Proprietary Limited, and it's got shareholders. And now next, the bank is actually going to lend the money to your company, your borrowing company. And then next, it on-lends the money to you. Next, you then buy the property. So you actually have a loan with your company and your company has a loan with the bank. The bank's still going to put you through, now the bank will put you through a 25 or 30-year cycle or put the company through a 25 or 30-year cycle. But there's no rules to say that you have to pay your company back at the same rate that you're paying back the bank. So you've got the company paying off the bank in, say, 25 years, but the loan between you and your borrowing entity can be interest only. And what that does is you're making payments back to the company. The company is then using that money to then pay back the bank. The company slowly turns positive geared because the loan's actually coming down, but your negative gearing stays, because of the interest only, your negative gearing stays around for a lot longer than if you were paying back the bank directly. Okay? Next, then I'm going to overcomplicate it one more step and put a family trust in as the shareholder. So now if we imagine this, if we set this thing up, the first couple of years isn't going to be very different. However, once you get to years 3, 4, 5, once that loan starts coming down, the borrowing entity starts making a profit because it's collecting interest off you at the initial high loan rate. You're still paying interest only based on the original loan, but it's only getting an interest deduction to the bank of a loan that's now coming down. So your borrowing entity is now making a profit, and that profit really represents what you would have lost in negative gearing if you'd gone straight to the bank. The profit's now sitting in a company, taxed at a flat 30%. I can declare that to come out through a family trust, and if I've got beneficiaries over the age of 18 on lower incomes, spouses or kids in uni, I can unlock those franking credits and get a refund of the franking credits while I'm still carrying a full negative geared property in my own personal name. So this is an ultimate way where the high income person can keep, and you can do an interest only loan for 25 years. You might say, I will go interest only with my own borrowing company for 25 years until I sell that property and then pay it back at that point in time. And in the meantime, we've paid off the loan. I've got my own borrowing entity, but really it's like my own internal bank. It's making the profit off me, and I'll distribute that to my low-income beneficiaries. So we've actually set this up a few times for a few people, and a lot of this is in lieu when you have a person on a high income that wants the negative gearing, and we can keep the negative gearing going for as long as possible while still pulling out the benefits of that negative gearing into low-income beneficiaries.
But how are they, I guess, so franking credits are from profits, tax paid on profits within a business?
Doesn't have to be a business, just profits paid on a company.
Okay, but if you're negatively geared, how are those franking credits distributed, or is it mainly when it goes positive cash flow?
It depends on the company. It's when the company turns positive.
Okay, perfect.
So the company's income source is you. You're paying the loan back to the company, and the company's costs is the bank. When you get down to, you might have paid half that loan off, the company's going to be positive geared. It's collecting more off me than it is paying to the bank. So it's actually making a profit off me.
Perfect.
And the financial disclaimers are, I was never here. I never said anything.
Talk to your tax accountant or financial planner. This is all general in nature. Nothing is personal financial information.
Indeed.
Yeah, it's always on our YouTube. We've got it on our disclaimers on all our episodes. But I think it's really important. Like, think of strategy first. I think a lot of people think about, I want to buy property, that's it. They don't think about price point. They don't think about yield. They don't think about what their strategy is. It's just like, I want to buy now, that's it.
Yeah.
So I think sit down and really, spend a week. What's my plan? What am I trying to achieve? I think they're the key takeaways for me. And there's obviously different structures that you can look at if you want to be aggressive on building out your property portfolio.
Yeah, that was fantastic, Dom. Thanks very much.
Thank you for having me.
All right. Jez, did you have any more questions or not?
No.
I've got one. So what's the mistakes that you see people, like when they're starting out, what's the mistakes that you would generally see? Like, I would think that people would make a mistake and then go to you going, why was this set up? Do you see many of those scenarios where all these structures have been, because some of it's complex. Like, I'm not going to say I'm a professional because I'm not at it. I'm not. But obviously I do sort of understand a lot of it, but people that are just starting out, it can be complex. You just trust an accountant and go, okay, yep, I just trust what they said. So do you fix other professionals' mistakes?
You can have your hands tied a bit because dealing with property, it's a large, lumpy asset that costs a lot to move. So it's things that are easier to fix can be refinancing or pulling apart loans into two different loans from one, perhaps. Where I see a lot of people, go wrong. It's not necessarily go wrong, but they buy their first house and then they want to go from their first house to moving to their second house, and they convert the first house to a investment property. But they've done the diligent thing and paid that loan off like crazy, and now they've got a $50,000 loan on something and it goes positive geared. So it's, if you'd thought about that at the beginning, then you would have done your loan structuring different. So that's probably one of the more common ones, is people that are stuck and they go, I thought I could just redraw on that and it'd be deductible, because it's not the security of the loan that makes it deductible, it's the purpose. What was the money used for? So that's probably a common one. So fixing, I think, borrowing, which is quite a can amount to a few $1,000s per year easily if you get it right. They're the ones that you tend to see a lot more of.
How about, I guess, money management? I know, like, I'm definitely big on it because I feel like that's the first step. Like, what's my income? What's all my expenses? And how much surplus have I got left over every month that I can inject to, be it super or into my portfolio? Because that's really the engine. So depending on what my lifestyle is, you can accumulate your portfolio. But do a lot of people ask about money management or talk about it, or not really?
They do talk about it now. For me, it's more of a broker type question. What I see is the people that, the classic is where they go, I only got approved for X, Y, Z, and they looked at my savings and they looked at this, but I know I can afford more than that. And you go, well, if you can afford more than that, start affording more than that. Start showing that you can put this much money away into a savings account. Don't say you're going to change the way you are. Start changing the way you are now, and then go to the bank with, look how much I've saved over the last 6 months. And then they'll use that that's a lot stronger than saying I can make do with $1,000 less of my clothing expenses from here on in, even though I've done it for the last 10 years.
Yeah, I think that's it. I think discipline's a key part to all of this. So thank you for joining us, Tom. I know you're going to be coming onto a future episode. We'll have to bank up some accounting questions, so anyone can leave comments in the comments section. But where can people find you?
So DPR Chartered Accountants is dprca.com.au. Our contact details are there, and someone will get in touch and we'll take care of you.
Perfect. Thank you for tuning into our 3-part accounting series. Bye for now and take care, and see you in our next episode.